All right, Jesse, want
Welcome,
to kick us off?
everyone. Sure. Welcome, everyone. Appreciate you taking some time to join us here on this Thursday afternoon. I know you're either just getting off work, maybe still at work, maybe getting dinner ready for the family. So appreciate your time. If you are listening to this as a recording, appreciate you taking a look at this opportunity. So we're going to jump right into this, try to keep this to 30 minutes or less. If anyone wants to see the full webinar that we recorded, feel free to reach out to Suja or I, and we'll provide that for you. But this is going to be more of an update of where we're at. We'll touch on a little bit of just the opportunity in general, but really kind of want to just do an update of how things are going and where the portfolio sits. So with that being said, let's go ahead and jump right in. If anyone has any questions throughout the webinar, feel free to just type them in the chat and we will get to them at the end. So let's just talk about the basic overview of what we're doing here. So many of you, sorry, I got a tickle in my throat. Suj, would you actually mind jumping in here for a
Oh
sec?
yeah, for sure.
Thank you.
Um,
Sorry about that.
so, many of you may have thought of owning an Airbnb on your own and as an investment property, and that is certainly a great strategy to get into Airbnbs. What we're doing here is we're removing all the hard work of being an Airbnb owner and actually really taking your investment to the next level. So, with as little as $50,000, you can invest in this amazing fund. It's going to have around 75 properties in it that are going to be expertly designed and going to meet the demands of the market and operated with incredible efficiencies and expertise. And as an investor, you just get to sit back and reap the benefits of that. So you've got tax benefits, you've got baked in appreciation, and really strong cash flow. You also have zero liability. Because if you were to say go out and buy your own Airbnb property, then you would be liable to, making sure the loan gets paid and anything that happens at the property. And also you get this instant diversification with our 75 plus properties. So this is a short-term rental investment, meaning you get to invest in a portfolio of 75 or so amazing short-term rentals without having to do any of the work that a normal Airbnb host would do. Our target market is families, so we're looking for those larger houses and where we can host family gatherings and group gatherings over 10 people. And yeah, so with this, and just really quickly, what we're doing is we're ramping up this fund by purchasing properties, and then we're going to stabilize them. And we can sell off the entire portfolio at once at the end of 5 years or at any point before then. Or we can sell off individual properties. So we will look at what our operator TechVestor, we're going to introduce Steve in just a second, what the most optimal strategy is when, over the course of the portfolio, but we have multiple exit options here. Jesse, do you want to jump in?
Sure. Sorry about that. And sorry, guys, I'm just getting over being sick, and I keep thinking I'm back to 100%, and then I start talking, and sometimes it all kind of comes back up. But this is a duplicate process of Fund One, which Suja was a part of last year, and we've been able to partner up on Fund Two here, where they raised about $37 million of equity, close around 50 to 70. What was the total on that, Steve, from last year's fund?
37.5 million or so, give or take.
Okay, awesome. So it's a duplicate of that process. We're looking at a 5-year hold. We're spread out across multiple markets. Very selective about which markets we get into. There was 8 exits of individual properties in that fund last year, and that was really to demonstrate the proof of concept to purchase, renovate, furnish, launch a property, and then be able to sell it on pro forma numbers to just kind of solidify the proof of concept. So this is a process that has been done before, and in Fund 2, we are just trying to optimize and grow that from the seeds that were planted in Fund 1.
Um,
Oh, and Suj, maybe you can chat about the performance as you were
okay,
involved last
yeah,
year.
so this is a representation of Fund One performance. And so what this means is, every property is going to be, we've projected how it's going to perform. And Airbnb short-term rentals is still a little bit seasonal. So all the green means that we're either meeting or exceeding projections, and the red are the months that we're not quite meeting projections. But as you can see, we're overwhelmingly in the green, which is just incredibly exciting to see. And based on this trending performance, we're going to be able to be delivering about a 9.6% annualized cash on cash return over the course of the fund. And right here, this kind of shows the trends with the overall seasonality trends. So the low season is kind of in this fall winter period, and then the biggest season is between February and August. And so we take all of that into account when we're considering launching the fund. With Fund Two, we've already purchased, I think we're at 30 properties, and we'll give some more updates on that. But we're going to have a lot more, and they're all going to be ready. Most of them are going to be ready for this big season right here. Okay, Sif, would you? Oh, so yeah, so just for those of you who don't know about me, I've been in commercial real estate for a few years, for over 12 years now. And I started out as an underwriter. I now own and operate my own properties, as well as raise capital for deals and help investors get into various passive investments. Jesse, how about you?
Sure. So my background is in cardiac sonography. Um, I still work in the field. I've been purchasing real estate since 2019 in the investment space, primarily in commercial. We have about 340 units collectively between Arizona and South Carolina prior to jumping into this fund. So my primary focus lately this entire year has been to provide opportunities for fellow medical professionals to participate in the deals that we do.
Awesome. Now, we're really pleased to have met Sif, who's on the call right now, and his amazing team, TechVestor. They have just a tremendous background, and I'm really just so impressed with what they're building and how they're managing this portfolio. And with that, I'd love to kick it over to you, Sif, to give an introduction to TechVestor and your firm.
Yeah, thanks so much, Suja. We're incredibly excited to be partnering with you and Jesse and your teams for the second time round as we do what we did in our first fund. Yeah, before I actually hop into team, if you don't mind, I actually would love to hop back over to this slide, 2 slides ago on that like little STR ETF slide is what we call it. And I want to just make a couple clarifications. So all our properties are actually meeting projections in pro forma. And I think, just to kind of clarify a little bit, maybe what Suja was talking about, these red blocks here are actually months where we're negative for the month in terms of a cash on cash. But on a annualized basis, all our properties are profitable, right? And the reason I want to just kind of call that out is this is really due just to seasonality and peaks and valleys. Not anything not meeting pro forma or projection. So I just want to maybe make that clarification. So hopping into the team, which is one of the few things that I brag about. I'm generally a humble guy for the most part. But the one thing I do brag about is the incredible team that we have here behind the scenes. And it starts with some of these incredible people you see on screen, right? Our head of operations, our head of data, our head of asset management. We come from both industry leading technology, real estate, and short-term rental specific companies. And we have been really, really excited to get to this point now. We've done over 125 plus homes, identifying, design, renovation, management, revenue management. We know just as much as what works as what doesn't. And we're seeing our second fund scale at a faster clip than our first fund, which is kind of that iteration of continued success time and time again. So I think it's a really fantastic opportunity to get in for sure. So on this next slide, you'll see that we have a very unique strategy when it comes to investing. And the first thing that's different is obviously our asset class, right? We're buying short-term rentals, right? But when we buy them, they're not actively short-term rentals. They're typically single-family homes that we're converting to short-term rentals. And as someone once told me, we're getting that development-like return without taking that development-like risk, right? And that's a risk trade-off that we really like in this asset class. Now, People think that short-term rentals, hospitality, we have to be competing with hotels, and that could be actually further from the truth in what we do. So we typically are buying a 4 or 5 bedroom home that is a $500,000 purchase that's going to do about $120,000 a year in annual revenue. And we're designing it purposefully. We're renovating it purposely. We're generating a ton of value add on that. And I don't know if anyone here has ever traveled with, 8 people, 10 people, 12 people. As soon as you hit a hotel with a group of that size, you're instantly separated because of physical space, right? And that is something that we believe impacts the consumer experience. And that's why bigger groups tend to choose Airbnbs. In fact, in our second fund, our average group size is about 9 people, right? And so when you think about 9 people going to a hotel, that's what, 2, 3, 4, 5 rooms of a hotel where there's no communal space. Not to mention the cash flow significantly better. It's pre-institutional. We talk to a ton of institutions day in and day out. And generally their thesis is, if you build it, we have an interest in buying it, right? But they don't have the time, energy, patience, or knowledge to build it themselves. So we're building the product that they're looking for. And the data ultimately backs us, right? Demand pacing is up. This is one of my favorite metrics to look up here in the top left. And I think this is due to a change in behavior, especially post-pandemic. People are planning to travel more. And by literally planning, they're going on booking further in advance. When people book further in advance, we get higher revenues because of what's known as booking lead time, right? In addition to that, what groups typically book furthest in advance? The larger ones, because they have 8, 9, 10 schedules they got to get on, right? So we're a natural benefactor of that flywheel time and time again. So it's a $150 billion industry. Demand is up, booking activity is up, nights booked is up. All these things are incredibly insightful to where we're headed and kind of what our thesis is in this space day in and day out. And as you'll see here, this is our type of competition that we're competing with. I like to call it the dorm room competition, right? These mom and pops who are, unfortunately just don't have the advantages that we do, right? They lack the design, the right property, the right location, the economies of scale, the team to actually operate and perform to a level where someone is really comfortable with that performance as well. And ultimately, these are things that we benefit from from time to time. And I know, Suja, you and Jesse have commented on like the design of our homes, and I hope you guys are continuing to see the trend continue in Fund 2 with these really awesome amenities that we're driving for occupancy, for revenue. It's really an awesome experience. It feels like I'm a kid sometimes, wanting to go in an adult's body.
Yeah, it's pretty night and day to look at some of those first pictures you were showing. And I think most of us have stayed in one of those Airbnbs before, and it did the trick. We were able to stay there. It was probably pretty affordable, but it's pretty night and day when you look at some of the amenities and the unique stays that you guys have created. Having a golf simulator or having a child's playroom actually in their room. And
Yeah.
some of the outdoor spaces are just incredible, and it sets it apart on the platform, and it helps the algorithm too, as far as where our properties get shown. When someone goes to Airbnb and types in what they're looking for, we pop up to the top of the list, and we have data to show that as well. Yeah, see,
Yeah,
you
and as
talking about performance and kind of the vertical integration piece too.
Yeah, happy to. So, when you look at revenue performance and revenue history, right? Who do we comp against? When you look at the largest professional manager in the country, which is Katha, we drive about 56% more revenue than them, and we win in every state that you see here on screen. We're driving 70% more revenue than the market in general, 40% more occupancy than them as well. What's really awesome seeing revenue at 70 and occupancy at 40 means we're able to actually beat on pricing, aka charge more, and have higher occupancy. In most cases, hosts are not able to get both, right? You're typically sacrificing either rate or occupancy. And in our case, we're benefiting on both. For those in the industry who may not know it, it's known as RevPAR. Our RevPAR premium is about 35 to 40% higher than our competition, because people want to book our homes, they want to book it more often. So that is really a really fantastic stat to look at. So how do we do all this? We call it the STR OS, our short-term rental operating system. It's powered by Superhost Labs, which is our operating company. We've hosted now close to, or booked, I should say, close to about 55, 60,000 guests, right? Just this past Thanksgiving, we had over 1,000 people, pets, and a ton of other, I'm sure, guests that we don't even know about, who were at our Airbnbs celebrating, thankful for the holiday period. And I'm happy to report we did not have a single kitchen malfunction. So everyone's dinners and everything was cooked beautifully. We did have turkeys on standby just in case. We want to always make sure we're delivering that great experience. So all this wouldn't be possible without this operating system that you see here. And what if we didn't have this? What does our competition have to do? This next slide actually kind of shows you how overwhelming it is to do the things that we do. You got to think about strategy. You got to think about finance, accounting, acquisition, technology, data, managing expenses, who's designing it, what are you designing, the amenities, who's permitting it. Fun fact, we have an entire team dedicated to permitting, right? It's a big deal, right? To make sure your permits always stays active, right? Making sure you're always in good standing, you're always in compliance, operations, right? Standardization of experiences. What about guest communication? It is a lot of work. And if we had to, go out and find 18 different vendors, it'd be more expensive, it'd be more costly, take longer, you get a worse product. So we built an entire vertically integrated company that does it exclusively for ourselves, right? And that's a really powerful strength. And that's a way that we're able to kind of get across the country. So as you'll see here on screen in a minute, all of these states with stars are where we're actually actively in. The ones with the rockets are the ones we have an interest in exploring. And you see kind of our general buy box, a $500,000 home doing about 100 grand in revenue, 8 to 12% cash on cash, really great value add opportunities there as well, right? In terms of the renovation, the flooring, we're the physical real estate really adding in that value. And all this is powered by both humans and by technology, right? And we have a human first, but we do have a data and software advantage when it comes to that. And on this next slide, you see a little bit of a screenshot of what our internal software looks like, where we're analyzing and underwriting hundreds of thousands of properties, millions, if not billions of data points at this point, whether it's revenue, amenities, and everything else that kind of comes in between. These are things that are really, really fundamental to how we think about success, advantages, and ultimately what other people can't do, right? We have a really scalable infrastructure. So I'll kick it over here to you, Suja, as we kind of talk a little bit about strategy.
Okay. So I guess these next slides are basically showing some more just amazing design when you really create an amazing experience with these murals and this is the Barbie house. It's very popular for bachelorette parties, etc. Then it really sets the listings apart. And so that's one of the things that drives occupancy and pricing. As you can see, every single room is extremely thoughtfully designed with wallpaper, and the photographs pop so well. There's everything matches and is on theme and on brand. And that really makes it more appealing for families to book because it just makes it a more memorable experience for everyone. In addition to all the amenities that are, in addition to design, there's of course all the amenities like the golf courses that you've seen and the game rooms and the hot tubs, etc., and patio lights. It's just, all of this is actually really hard to do for mom and pop owners to do it really well and expertly. And that's one of the reasons why we're so excited to leverage the expertise of the TechVestor team. So just getting into the numbers a little bit, the minimum investment is $50K. We're projecting to hold for 5 years. So, you should just plan on that. And 100% of the tax benefits are passed through to investors. So you will see some depreciation or paper losses in year 1 and year 2. We do quarterly cash flow. And then we're projecting about a 9%, 8.5% average cash on cash return, and about a 19-20% total average annual return. You can invest with your STIRA if you need to, or with cash, same as other syndications. And again, we're looking at investing in about 100 properties. So we've got an 8% preferred return built in to make sure that investors' interests are prioritized. And then after that, investors still get the majority of the profits. And here's some more into the numbers. So you can see a little bit what the cash flow projections are looking like. So year one is going to be a little lighter because the fund is ramping up. So we've already, this is a great time to get into fund two. There's already 30 properties and a lot more that are currently under construction and getting ready for launch. But it takes a little bit of time to stabilize those properties. So year one cash flow will be slightly lower and then it'll ramp up. And we are also doing a there's a projected IRR of about 16%. And if you want to take a deeper look at this, it's available on our portal. Okay, Steve, do you want to talk about the ramp up period?
Yeah, speaking of ramp, great time to invest in Fund 2. And let me tell you why. We're recording this on November 30th. If you make your investment in December, really when you watch this webinar, your first distribution is going to be in February, right? So you're talking about 60 days to cash, which is really, really quick. Now, it may not be a huge amount of cash, but it's going to be that first feeling of getting that mailbox money, as we all like to call it. And it's always a good feeling to get something back from an investment, right? And so, not to mention, this is in this year, you're getting 80% of depreciation on bonus depreciation, which goes down to 60% next year. We're at about 31 listings right now, 31 properties, give or take, active. And we'll have projecting another 12 or so to go live this month in December, right, alone, which is going to be about 40 properties eligible for bonus depreciation in 2023. So if you're on the fence and you're thinking about putting in some money now, maybe some money next year, I would certainly encourage you to consider putting in some money this year to take advantage of that. Take advantage of this ramp period, get in, accrue that preferred return, right? It's a 6 to 18 month ramp because we're adding a lot of value, a lot of built-in equity, right? We want to hedge those risks. And speaking of risks, on this next slide, let's talk a little bit about what those risks look like in our opinion. Now, the biggest risk in real estate, in our opinion, is about debt. And our debt structure is really unparalleled to anyone else's. All of our debt in Fund 2 is at minimum fixed for 10 plus years. No floating debt, no balloon debt. In fact, most of it, about 70, 85% of it, is actually 30-year fixed rate debt, right? We have our DSCR average is going to be in that 2.5 to 3.5 range, depending on the month. That's a really healthy DSCR, stands for debt service coverage ratio. We're driving 3 times the value of our NOI compared to the cost of our debt. Not to mention, we're putting about 25% down on these homes, and then we're doing a bunch of work to them, right? So 25% equity based on appraised value, doing things like flooring, kitchens, renovations, obviously all the amenities we do. So we have typically about a 65 loan to value, 60 in that general range on a post renovation basis. That's a risk reward ratio we're really, really happy with. And none of our loans are cross collateralized, right? So if for whatever reason, in the off chance, the very, very rare chance, something happens to a property and we have to lose it, it doesn't affect the rest of the homes, right? So that's, again, just a risk mitigation strategy that we're really happy with as well. And so, can someone compete with us? Sure, they can. But it'll take a lot from them to really get on our level, right? They'd have to build our infrastructure. They'd have to have that capital. They'd have to have the team. They'd have to have the technology. They'd have to have the traction, the knowledge, and all these things that are going to allow them to get to where we are. And, to be frank, there's no way to accelerate those lessons. You kind of just have to go through them, which day in, day out, we get stronger and stronger from a competitive standpoint. And kicking this over to Jesse.
Yeah, to dive back into taxes. Taxes are not the flashy or sexy piece of this deal that probably got you to come to this webinar, but it is such a vital piece of the puzzle for a high net worth or a high earning individual. As you know, the more you earn, the more you pay in taxes. So one of the beautiful benefits of real estate in general is depreciation. And we do cost aggregation studies, which accelerate the depreciation of our assets and create a paper loss, as Suja talked about, meaning that our tax documentation that we're going to provide prior to tax season next year is going to show a loss on that K1. How you get to apply that to your personal tax situation, absolutely talk to your CPA about that. We can't go through that with you, but those losses, even if I've had losses in the past where I can't take them all in year one and they just roll over to the next year. So that's one of the beautiful things about this is that you get to enjoy the cash flow, the appreciation, the equity play, but you're also showing a loss in your taxes. So it's a win-win scenario from that standpoint. And then also one of the really cool pieces about this is owner stays. So as owners, we get to stay at these properties for a discount. I 100% plan on staying at multiple properties with my family over the course of the whole period. And we absolutely encourage you to do that as well.
And then Steve, do you want to take this slide?
Yeah, yeah. When I talk to investors all the time and, they ask us, why us? Why short-term rentals? Why this asset class? Why now? I generally kind of boiled it down to these 6 things. And the first thing, ultimately at the end of the day is the people, and again, humble brag, but we really do have the best team in the space, in my opinion. Right. And that's a huge, huge deal to us when it comes to operating. Proprietary technology and access to data is critical to our success. We have everyone from, heads of data firms in the space to data providers who sit on our advisory board just for that reason, to make sure that we have exclusive access to certain information. Traction, aka experience, aka scale, right? We've done this once, twice, 120 times later, and I can assure you, the properties today are significantly better than the first ones we launched, and even those are doing all right, right? So we're getting better with time. We're vertically integrated. There's no red tape. We can make decisions, right? We can move quickly. We have the best product delivered by the best people. The asset class is being dominated by mom and pops. 95, 99% of this industry are people who, they're your neighbor. They have a job. They don't know what they're doing on a day-to-day basis. This is not their go-to. That is music to our ears, right? Wish them the best, but this allows us to, really just overly perform comparatively to the market, which really drives those outsized returns. Lack of professionally operated STRs is a big one in the space, right? Less than 20% of all short-term rentals are actually have a professional manager, let alone someone who's actually good at what they're doing. And that data, that design, those are big, big things that we look at on a decision in and decision out basis.
Awesome, thank you. All right, so the next steps to invest are to log into our investor portal, and you can contact Jesse or myself to make sure you have access to the portal. And now we're going to do just a couple quick questions. See, just had a question. I know you kind of spoke to this, but could you just give us some more details as to how Fund 2 is progressing?
Yeah, so Fund 2 is progressing pretty well. We have about 31 properties live right now. And this is obviously in November. We had 17 through end of Q3. We have another 20 or so that have yet to launch. And of those 20, I believe close to about 12 of them will launch in December, right? So they'll be placed in service, and that's important from a tax benefit perspective as well as from a cash flow and ramp perspective. We have about $31 million invested as of right now, give or take, in Fund 2. And we're probably going to add another property or 2 or 3 as we continue to scale here, especially in our December round. We're exceeding expectations by far in Fund 2 on revenue, and we're actually seeing our expense ratio on Fund 2 being significantly better than Fund 1. And it's because we caught things a lot earlier in Fund 2 than we did in Fund 1, right? You learn from kind of what happened in Fund 1, and you're like, okay, we don't want to do that again, right? Because we're going to try something else. So that's a long-winded answer of Fund 2 is performing, above expectations when it comes to revenue. And I think we're early enough to say that I think we're going to have a really fantastic 2024 with the current projection revenue on the books.
Okay, awesome. And then another question came in, which was about the exit plans and interest from either institutional buyers or retail buyers. Like how do we feel about our exit projections or prospects?
Yeah. I think naturally we have tons of conversations with institutions. I mean, I had 3 this week, and their thesis has been all very similar. They want to get into this asset class, but they typically have 1 of 2 choices, right? They can either buy or they can build. And what I mean by that is they can build a portfolio, but it's too slow for them. They don't have the knowledge, they don't have the confidence, they don't have the team, right? It's too new to most institutions. And then they can buy, but there's nothing to buy. There's no portfolio that exists large enough that's interesting enough to them. right? We're building that portfolio. And when they see what we have and the track record that we have, I think a common thing we hear is, we haven't met an operator like you with this amount of track record yet. And that's really interesting, right? So imagine what that's going to sound in 2 years from now, 3 years from now, 5 years from now. And I want to remind us that while we do plan to exit in the next 4 to 6 years in this way towards an institution, because trust me, it's a lot easier to sell that way than one by one. If we can't sell that way, we have great real estate assets with built-in equity on a high cash flowing yield compared to other asset classes, and fixed rate debt. We have time on our side. We have optionality. We have choice. A powerful place to be in real estate.
Okay, awesome. And I think the last question is, how is Fund One performing?
Yeah, Fund One is also performing pretty well. I think Fund One did roughly $800,000, $900,000 in revenue just in November alone, and it'll have its first $1 million in revenue month in February of 2024. Revenues also exceeding expectations. In the data room that Sujay and Jesse has, we actually share all our public data on a property level by fund, so anyone can actually access it. And it's really interesting to see. And Sujay, if you don't mind, I know we're going to end here in a second.
Yeah.
I can just drop the link for you in the chat, but it's a really fantastic perspective of how we're doing versus market. This is in the data room. It's for Fund One, Fund Two by quarter. So if anyone's ever interested in exploring it, whether you're an investor or not, it's public data. We share everything. Please go nerd out, ask questions. And we'd certainly love to answer more questions on that. But Fund One is doing pretty well.
Okay, yeah. So this is what it looks like. For some reason, it's loading kind of slowly right now. But all right. Well, with that, we don't have any other. Oh, did you want to give a brief walkthrough on this, Steve, just while we're here, and then we'll end.
Sure. I don't see it on your screen just yet.
Oh, sorry. Let me
yeah.
a new share. Okay. Now
Perfect. Yep. So this is really awesome. So this is what you're seeing is, Sujay, if you go to STR2 Q3, which is the tab to the left. Yep. So this is actually like last quarter's data for Fund Two. If you go ahead and click into that. So you can actually see these are the 17 properties live through end of Q3, and half of them didn't even have about 30 days of data, right? So they're brand new, brand fresh. We're pacing 27% ahead in column U of where we expect it to be at this point when it comes to revenue projections. Those properties delivered in quarter a 1.4% cash on cash. And the reason I think that's awesome is half of your properties weren't live for more than 30 days, right? So like that's a really awesome indicator of kind of where those are going. But you can also see our RevPAR, which is one of our main metrics we look at in column L. Our RevPAR is 331. Basically, what RevPAR is, you can take that 331 number, multiply by the number of days in the month. That's your average revenue. And we're doing roughly $10,000 a month per property that we have in the portfolio on average right now. And this is even before ramp. We're seeing about a 9 to 10% year-over-year increase in revenue in Fund One. And that's going to be something that I think Fund Two will continue to see as well. So that's how to read this. If there's also a legend, in the fifth tab, if anyone has any questions, happy to answer any questions on it as well.
Awesome. All right. Well, thank you everyone so much for coming on the webinar and for watching it. I know a lot of people are going to watch this after we post it. Jesse, do you have anything else you want to say before we sign off?
No, I just again want to say thank you for your time, and feel free to reach out if you have any questions.
All right.
Thanks, Pals. Thanks, Sujay.